This question comes up a lot. What happens if everyone just buys index funds? And I can understand why it does, because all of the advice you hear on YouTube, across social media, and in some of the most popular investing books is exactly that.
We just buy an index fund and never look at a headline, never think about stocks anymore.
Buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one.
I'm talking about index funds.
Practically buy a small portion of every single stock in existence without having to do any of the legwork buying each of them individually.
If you want to get rich from investing, index fund investing is one of the best investments you can make because they are super easy to manage and also super well diversified.
So what's the issue then? Well, let me explain why people think this could be a problem, but more importantly, why I think it's not the real question we should be asking. Anyway, first up, let's just start from the beginning. What is an index fund and how is it even made? Well, as many of you will already know, an index fund is just a collection of investments put together on a list, and it can be based on a huge number of different characteristics. For example, think of things outside of the investing world that are pretty much indexes. The Football Premier League is a good example of an index of the best football teams in the UK, maybe even the world, and that light blue team not far from me is apparently the best one. The Sunday Times Rich List could be another good example, an index of the richest people in the UK, just sorted by how rich they are. And then finally, what about the top official singles chart, the best-selling music index in the UK, designed to make you realise just how old you really are when you have no idea who most of the artists are. Anyway, back in the investing world, many of you will know the most famous indexes like the S&P 500, an index put together by Standard & Poor's of the largest and most powerful companies based in the US. There's 500 companies on the list, and it's sorted by company value, often referred to as market cap, a word short for market capitalization. If you add up all of the shares in a company, that's how you get the market cap. And then the bigger the market cap, the further up the list on the S&P 500 you sit. Now, there are loads of other indexes out there as well, such as global index funds, which take almost all of the large companies in the world, and then they just do the same thing. They get all of them together and organize them in a big list, and then just like the S&P 500, they sort them by their market cap. And you often get the same companies in both indexes when they're sorted this way. A good example might be something like the FTSE All-World Index. Closer to home, many of you would have heard about the FTSE 100, which is just a list of the biggest 100 companies who are headquartered in the UK. Again, also sorted by their market cap. Now, with the basics covered, let's just consider for a second how a company inside an index even gets its market cap in the first place, as this is really key to this question. Ultimately, the price of any company in any given stock at any point in time is just based on supply and demand. If more people want to buy a stock than want to sell it, then this will push the price up. And if more people want to sell a stock, this will cause the price to drop. It's all just a very careful balance, and it's exactly the same with anything you might want to buy. Buyers match up with the sellers, and then the price just gets adjusted accordingly. This is why the likes of Microsoft, currently the most valuable company in the world with a market cap of just over $3 trillion, is worth more than all of the companies in the FTSE 100 combined. Buyers and sellers have agreed that this is the right price. It really is just that simple. Now bring this back to the question. You or I can only buy an index fund because the prices have been set by the market. There are so many people in the market and so many players. And for us to make any buys at all, we need someone to sell it to us. For example, if you buy an index fund sold as an ETF, then every share you buy has to be sold by someone else. And even if you buy a mutual fund from the likes of Vanguard that might allow lots of people to buy it, that fund still needs lots of people to sell the shares which are inside of the fund itself. Otherwise, they'd have nothing to do with your money. This whole industry only works with a healthy supply of sellers and buyers. So first off, I think the problem with saying that what happens if everyone just buys index funds isn't quite getting to the root of the question. I think what people really mean though is that as more of this money pours into the market from people who invest just every month without trying to actively pick stocks, doesn't this just inflate the price of the biggest companies? After all, if more and more people are choosing to invest just using index funds, then won't the price of Microsoft, Apple, Google, and Meta just get out of control and start to go into a bubble? Now this is worth considering. If we take the S&P 500 and break it down, here's what it looks like at the moment. The total weight of the top 10 stocks, which include all of those big names, makes up almost 34% of the entire index. And as you can see here, This is the highest it's ever been in recent times, going back to 1996. Looking at this, you can easily see why a lot of people are concerned that many of these stocks are just too expensive and maybe in a bit of a bubble. You can also see this in action here on this graph, which shows the PE ratio of the top 10 stocks when compared to the rest of the 490 names in the index. Right now, it's not the highest it's ever been, especially when compared to the dot-com bubble, but it's pretty high when you compare it to the rest of the names, with an average of more than 26 times. Remember, this means that you will need to invest $26 for every $1 that these companies produce in profit. And some people will say that this is just too high. Now, it's very easy to fall into a simple trap if you look at this data and just say, wow, clearly stocks are very expensive and those index funds must be causing these problems and making it worse. But I think this is way too simplistic, and as usual, you need to focus on the detail if you want the full picture. For example, if you believe that companies generally get a higher share price because they're getting better and producing more profit, and also that they're generally fairly priced at any one time because the market is efficient, then you might be interested to see this. From the end of the dot-com bubble, the profits of the companies inside the S&P 500 have risen and now sit at 12.1% on average, which is way more than they have been in recent history. And it's not far off their all-time highs. Also, if I just go back to the other slide for a second from this report by JP Morgan, we can see that the top 10 companies in the index are actually pulling their weight, delivering 26.4% of all of the earnings. Here's another bit of data that shows this even clearer. Now, this one is from Goldman Sachs, and it shows the market cap of the top 10 companies in the S&P 500 with this light blue line, and then the earnings per share in the black line. Now, although the market cap is at an all-time high, so are the earnings, and it's not like the dot-com bubble where the two lines were completely out of whack and the earnings just weren't living up to the valuations. So I don't think you can just make an argument that just says index funds are causing some of these problems and the market to go into a bubble and this needs to stop. If earnings rise, then it's only right that prices rise as well. After all, isn't that what investing is all about? In fact, why don't I show you something else which is a really good reminder of just how powerful the market is overall. So when companies release their earnings reports for the last 3 months, there's often a huge focus on them, and lots of investors look very closely to make sure that they aren't missing anything. The moment results are announced, a company's share price can change dramatically. It can swing up or go down or even just do nothing. Now, if everyone really was just buying index funds or claiming that they were destroying the functions of the market, big swings in prices of stocks would just not be possible on these earnings days. In reality, there is such a huge trading and investing community that they can cause huge swings in the prices of stocks. Just consider the latest earnings of some of the biggest technology stocks. To move the price of these companies, you would need a huge amount of buyers and sellers, and a huge number of shares. For example, let's take Meta as a good example. Back in the first quarter, they reported some great results and their share price rose by 20% in a single day. There is no way that index funds can do that. Likewise, on the most recent earnings day, the stock fell by 10%, showing yet again just how many active players there are out there in the market. The active players are the ones out there setting those prices and making a stock price move like that, especially when the stock is such a big one like Meta. So do just consider that for a second. Now, there's no doubt that these active players have been shrinking as passive index fund investing has become more and more popular over the past few decades. In fact, the passive index market has been on a bit of an unstoppable rise, with more and more money flowing in from investors like you and me. Some of the money has come from active funds, with people taking that money out and putting into passive ones. But still, even with this mighty growth, there is a huge amount of money in the active market. Morningstar, who tracks this data, says that the active market has over $13 trillion inside of it. And this is matched by the passive market with another $13 trillion. We are nowhere near any kind of saturation point, and anyone worrying that index funds are in some kind of bubble are either trying to sell you their expensive funds or just lying to themselves. Now, for argument's sake, let's just keep the story going and assume that the passive growth continues and people keep on moving to buying index funds. At some point, surely something has to give. I'd argue that as passive investing grows, this should weed out the bad active managers and just leave you with the best of the best. After all, go back to why you might be investing in the first place. Most people just want to make the best returns they can with the lowest possible risk. Why pay money to a fund manager who can't beat the returns of a passive index fund? It makes no sense at all to me. Money will flow to where it gets the best returns. And if the best returns are in a passive index fund, then so be it. The evidence for this change is very clear, and you might have heard this many times before. Active fund managers, the people who try and pick and choose the right stocks to buy, have extremely bad track records, and almost nobody can beat passive index funds. This also includes retail investors as well, like you and me, but maybe a bit more on that topic later. Here's some of the latest evidence from Morningstar, which tracks the performance of all of these different funds. Now, there's a lot of numbers here, but just bear with me. What this shows is the percentage of active fund managers who manage to beat their category. So if active managers were any good at all at their jobs, what you'd hope to see here is some very big and large numbers. Let's have a look at a couple examples and just see how they got on. This top line shows funds that are invested in large US stocks, and it says that over the last 20 years, just 10.4% of the funds have managed to beat their index. So this means that almost 9 out of 10 of them failed. And you would have to wait 20 years to find that out. Things get even worse in the category of US large growth, with just 4.9% of funds beating their index over the last 20 years, and only 2.1% beating it over 15 years. These are just crazy statistics. Also, there's no mention here of how much they've beaten the index by. Can you imagine if you were able to filter this to say, only show me funds that have beaten the index by 5% or more? I bet that number would be tiny. Now, just to play fair and be a devil's advocate, there are some green shoots here, and I don't think it's fair to say that all managers are bad. For example, you will see some areas with quite a high success rate, and they tend to be in the more specialized areas. For example, in the corporate bond fund sector, 75% of the funds in the last 10 years have managed to beat their index, but there were ones with the highest costs. Also, in the US small growth sector, 50% of the lower cost funds have managed to win. However, let's be very honest here, if you're paying for a service, even a low cost one, for an active manager and only have a 50% chance of winning over 10 years, I just can't really get my head around that. Surely, active fund managers need to get better and prove their value, otherwise passive is just going to keep growing and growing until it reaches a point where beating the market should be easier. After all, if the market gets the pricing wrong, this should mean, in theory, that the managers should be able to spot the errors better, meaning that they have an easier time to beat their markets, but who knows? The market should fix this, and if there is an opportunity, someone should be running in to fill that gap. Now, I think this leads me on to probably the biggest key reason I think that there will never be an issue with everyone buying index funds. Putting to one side the fact that it's not possible anyway to only be a buyer, the biggest reason that there's no issue with passive investing is that there is just too much at stake, and us humans are going to keep being human. I was trying to think of a good example of this earlier, and I think I found it. Think of the people at the top of their game. Maybe it's the best footballers, the best singer, or maybe your favourite actor. At the top of any industry, there are only a handful of spaces to be filled, yet there are millions of people who are all trying to take their spots. Why? Well, because if you make it, the rewards are just incredible. If you get to play for the top football team, you can earn huge money, get all the trappings of wealth and have an amazing life. Likewise, if you make it in the entertainment business, the world is your oyster. The money, the fame, and everything that goes with it. Millions of kids dream of becoming the next big thing, no matter what it is. And they don't care if the chance is only 0.00001% of people that might actually make it. All they see is that it's possible, so it's worth a shot. In a way, it's a lot like playing the lottery. Your chances are tiny, but there is so much at stake that it seems worth it to play, as somehow, every single week, a few new millionaires are made. I think investing actively in the market is very much like this, as we look up to people like Warren Buffett who have proven that it's possible to do. What we see on TV or on social media are the big winners, but we don't hear about the many people who've lost it or not made it. People give it a shot to try and be the best because there is just so much at stake. I mean, imagine this. A company like Nvidia has gone up in value since its IPO by more than 225,000%. Will there be some people who have owned shares since the beginning? Probably yes, but only a tiny amount compared to the hundreds of thousands of investors that have ploughed in since. Just think, a small investment at the right time can have life-changing outcomes, and that is ultimately why active investing isn't going away anytime soon. We can all argue whether it's all down to luck or there's skill involved, but all that matters is the outcome. And that outcome, for some people, is worth the risks, even if they really don't understand the likelihood of their bet paying off. And to be honest, I think that's completely human, very normal behavior, and it's what makes the market in the first place. If we want to enjoy investing passively, we need the active market to be healthy and to thrive. And there's no better way for it to thrive than to have the enormous rewards that can come with being right, even if being right is a long shot. After all, if it was so easy, then anyone would do it, right? So what do you think? I'd really like to know your comments on this one because it's quite an interesting topic. Also, it's worth saying that I am mainly a passive index fund investor, but I still do enjoy picking some stocks on the side. You don't have to just pick one or the other here, and I'd bet that most of you out there are quite similar. A majority of index fund investors, but also play around with a certain amount of money on the side too. And why not? If we only ever did things based on the chances of success, humans would have never survived or tried anything new. So what happens if everyone buys index funds? I don't think that's a real issue at all, and it's a bit of a false pretense. And even if it was somehow a bad thing, the market will quickly let us know eventually. I'll see you in the next video. Happy investing.